Hello students, today's topic for marathon is share capital and debentures and it is having a weightage of 7 marks. So before I start marathon of share capital and debentures, let me show you the weightage of this chapter in your previous attempts. In CA Inter previous examinations if you see. So yes, of course this chapter share capital and debentures, even though it is covered under 1/4 strategy chapters, topics wise you can see more number of topics are there, but if you are able to remember the content, you can easily score good marks in this chapter. So you can see the weightage of this chapter. Share capital, you know, you can expect one descriptive question and one multiple choice question. 5 marks descriptive question and 2 marks multiple choice question. So on an average, you can expect 7 marks from this chapter. Getting my point? Fine. So now let's continue our marathon. Share capital and debentures. Total 30 sections are there, 43 to 72, and I designed some 16 exceptional questions. So after going through these questions, you'll get much concept clarity. You'll get utmost clarity in these concepts. Clear? Chalo. First one, what is a share? Share means share in the share capital of the company and includes a stock. Stock is a collection or bundle of fully paid up shares. So company cannot issue stock directly. First company will issue shares. If the shares are fully paid up, then those shares can be, which shares, fully paid up shares can be converted into the stock. A limited company having a share capital can convert fully paid up shares into stock. So you may get a question. So company wants to convert partly paid up shares into stock. Possible or not possible? Not possible. Only fully paid up shares can be converted into stock. Sir, what is the difference between shares and stock? Share is a unit in the share capital, whereas stock is a bundle of shares. Share is available in natural numbers, 1 share, 2 share, 3 shares, 4 shares, but stock is available in fractions, 5% stock, 6% stock, 1% stock. Getting my point? So transferability point of view, compared with shares, stock is suitable. So stock is stated in lump sum, whereas share being the smallest unit. Ordinarily shares are issued to the shareholders, while in case of stock, fully paid up shares are converted into stock. So direct issue of stock is prohibited. First we will issue shares. If the shares are fully paid up, upon your request we will convert shares into the stock. Thus stock is not issued originally, but it is obtained by conversion of fully paid up shares. And kinds of share capital, this is section 43. We are having two kinds of share capital: equity share capital, preference share capital. So equity share capital means share capital other than preference share capital, whereas preference share capital means a share capital which carries preferential rights, that is dividend payments, repayment of capital. When compared with equity shareholders, preference shareholders get two priorities. One is dividend, the other one is redemption of the capital. Now coming to equity share capital, there are of two types of equity share capital. One is ordinary shares, other one is differential rights. Generally, one share, if you take fully paid up share, one share equal to one vote. But coming to differential rights, one share need not be equal to one vote. So best example I take in class is Tata Motors differential rights. Tata Motors differential rights. The specialty of these shares is 10 shares will give you one vote. Public point of view, they subscribe shares not to exercise voting power in the company. They subscribe shares only to get higher returns. Banks will pay interest just some 6%. So they expect more returns. That's why they're ready to take more risk. So if you're taking more risk, you definitely expect more returns. So public point of view, returns. Whereas promoters point of view, superior voting rights. Getting my point? So Tata Motors issued differential rights where voting rights are inferior to ordinary shares. Preference shareholders may also participate in the equity pool. We call them as participatory preference shares. After payment of equity dividend, after payment of preference dividend and equity dividend, balance surplus left over. In that balance surplus, along with equity shareholders, if preference shareholders are also getting dividend rights, then we call them as participatory preference shares. Let me tell you one more time. Net profit after tax minus preference dividend minus equity dividend. So whatever net profit is left over, in this generally equity shareholders will have a share. Along with equity shareholders, if preference shareholders are also getting share in this net profit, then we call them as participatory preference shares. Next one, equity shares with differential rights. Companies AOA shall authorize issue of equity shares with differential rights. See, for issue of equity shares with differential rights, remember default MOA. The cheat code is default MOA. A stands for Articles of Association. O stands for Ordinary Resolution. M stands for Maximum Limit. And yes, there are some defaults companies should not possess at the time of issue of equity shares with differential rights. So AOA authorization. Second one, Ordinary Resolution. For unlisted company, ordinary resolution shall be passed at general meeting. Coming to listed companies, ordinary resolution shall be passed via postal ballot. So postal ballot kind of voting is applicable only to the companies whose equity shares are listed on recognized stock exchanges. For unlisted companies, at general meeting, ordinary resolution will be passed. Don't get confused between OR and SR. Here SR is not applicable, OR is enough. Next one, voting power of shares from the differential rights shall not exceed 74% of total voting power of the company at any time. That means, voting power from differential rights less than or equal to 74% of total voting power of the company. Less than or equal to total voting power of the company. If you ask me to write another equation, voting power from differential rights less than or equal to 74% of voting rights, voting power of ordinary shares plus voting power of differential rights. That's it. And company has not defaulted in filing financial statements or annual returns for the past 3 years. Past 3 years, no default in filing financial statements, no default in filing annual returns, and there should be no subsisting default. At present, when you are issuing equity shares with the differential rights, at present, you should not have these defaults. Dividend payments, deposits repayment, interest thereon, debentures repayment, interest thereon, preference shares redemption. So company has not defaulted in payment of preference shares dividend, payment of employee statutory dues, transferring IEPF dues, repayment of any term loan from PFI, public financial institutions, state level financial institutions, banks, interest payable thereon. But if you have any of these defaults, first rectify them. After rectification, wait for 5 financial years. After rectification, wait for 5 financial years. That means 5 years ban. And company has not been penalized by the court or tribunal in the last 3 years under RBI Act, FEMA Act, SEBI Act, Securities Contract Regulation Act, or any other specific sector laws. And existing equity shares with voting rights cannot be converted into differential voting rights, also vice versa. Conversion not allowed. Only through issue equity shares with the differential rights comes into the picture. Holders of differential voting rights shall have the same rights as other equity shareholders like bonus or rights issue subject to the differential rights. The register of members shall include details of differential voting rights with the shareholders details and disclosures in the board report. See, 10th point, 11th point is about disclosures, and this section 43 is not applicable to IFSC public companies and all private companies if AOA provides for it. Section 6, if you remember, incorporation of company, I told you. Section 6, Act overrides MOA, AOA, but sometimes Act gives superiority to the AOA. So private companies, IFSC public companies, if AOA provides otherwise, section 43 is not applicable. Clear? So based on this, let's see one exceptional question. Sunrise Tech Limited, incorporated in Maharashtra 2017, is engaged in manufacturing smart home devices. Company has been earning a distributable profits consistently for the past 4 years. Earlier, before amendment, 3 years distributable profits condition is there. That means after incorporation, wait for 3 years for issue of differential rights. But right now that condition is not there. Upon incorporation, immediately you can issue equity shares with the differential rights. Getting my point? Earlier 3 years condition is there. Now that condition is not there. So this is not a matter at all. The paid up equity share capital of a company as on 31st March 2025 is 20 crores, consisting of only equity shares with normal voting rights. To raise further funds for expansion, board proposes on 15th April 2025 to issue equity shares with the differential rights carrying 10% voting power compared to normal equity rights. That means what? Generally one share equal to how many votes? 1 vote. But this differential rights, 1 share equal to 1/10 of the vote. That is a meaning, 1/10 of the vote. The details proposed are number of shares to be issued 40 lakhs differential shares. Face value 10 rupees. But if you see the voting power 40 lakhs into 1/10, that is 4 lakhs only voting power. Whereas ordinary shares, you see, ordinary shares 20 crores divided by 10 means 2 crore shares only. 2 crore into 1 vote means 2 crore votes. 2 crore plus 4 lakhs, you see total voting power. You see the total voting power 2 crores plus 4 lakhs. So 2.04 crore. So if you observe 4 lakhs divided by 2.04 crore, the voting power is within the limit only. Within the limit of 74% of total voting power of the company only. So allowed. Paid up post issue equity share capital is 24 crores, correct? But voting power is different, ma. Voting power, it is just 2 crore 4 lakhs only. Why? 1/10 of the voting power. Net worth 50 crores. Listed or unlisted? The nature of company is unlisted public company. Articles of association do not currently authorize issue of differential voting rights. So AOA is silent. AOA is silent on issue of equity shares with the differential rights. So this is highlighting point only. Do not authorize. Company defaulted in repayment of the loan installment to a scheduled bank in financial year 21-22, but cleared the dues on 31st March 2024. So to this add 5 years. That means till 31st March 2029, company is prohibited from issuing differential rights. 5 years, term loan repayment, interest on term loan repayment. In case of these defaults, you have to wait for 5 years from the year of rectification. The board proposes to approve the issue through a board resolution only without shareholders approval. No. OR is required, and such OR should be passed at general meeting because the nature of company is unlisted public company. If it is a listed company, OR shall be passed through postal ballot. So OR is required. Company defaulted in filing financial statements for the year ended 31st March 2018 and 31st March 2023. So 22-23 you committed a default in filing financial statements with ROC. Therefore 24-25, 23-24 and 25-26, these 3 years disqualification only. After 31st March 26 you are allowed. Up to 31st March 26 you are not allowed to issue equity shares with differential rights. Company defaulted in repayment of deposits in financial year 21-22 but fully cleared the dues on 31st March 2024. See, repayment of deposits is covered under subsisting defaults. Repayment of deposits covered under subsisting default. You can see here. Subsisting has not defaulted. No subsisting defaults for deposits. That means upon rectification you can proceed with issue of equity shares with the differential rights. Okay, so that means here from 1st April 2024 onwards allowed. The finance director claims that since company has cleared its earlier bank default and is unlisted, it may proceed without further compliance. So you have to tell, is it valid or invalid? So if you observe point wise, articles authorized DVR? No. So AOA amendment required. OR in general meeting passed? No. Just board approval passed, which is invalid. DVR limit, how many votes are there? 4 lakh votes. It is within the 74% limit only. So condition satisfied. Default in bank loan repayment, wait for 5 years. That means up to 31st March 2029 you are disqualified. Unlisted company, postal ballot not required. ROC filings 31st March 23 you made a mistake, so wait for 3 years. That means after 31st March 2026 only you are allowed to issue equity shares with differential rights. Default in repayment of deposits cleared on 31st March 24. So yes, rectification happened immediately after 31st March 2024. DVRs are allowed. But if you see all these conditions, if you see all these terms and conditions, up to 31st March 2029 you are not allowed to issue equity shares with differential rights. Getting my point, everyone? So whichever is later we have to take. Up to 31st March 2029 you are not allowed. So everyone just comment, is it so you tell me, is this an exceptional topic or not? So generally students read 5-year conditions, 3-year conditions, subsisting defaults, but if a question comes like this, then application of provision you will do. Getting it? So in my opinion this is really an exceptional question only. Just I'm asking you. Okay, fine. Next, question 2 is about voting rights, but before that we had few sections to complete. So the few sections we have to complete is section 46. So what is section 46? Share certificate. I'm not talking about demat form of share certificate. I'm talking about non-demat share certificate. So share certificate will be valid only if it is distinctively numbered, issued under common seal of the company, signed by 2 directors or signed by 1 director and 1 CS if appointed. Next one. If the composition of board permits, if at least one of the aforesaid 2 directors shall be a person other than MD or whole-time director, do accordingly. So signature means you can affix, a digital signature or lithography, engraving. All these methods are also allowed, but not by rubber stamp. Rubber stamp is not allowed. So again, for duplicate share certificate, if original share certificate is lost or destroyed, or if original share certificate is defaced, mutilated, torn, you can apply for duplicate share certificate. For this, you have to pay 50 rupees per certificate. Okay. Next one. Disclosures. So disclosure on the share certificate. So duplicate issued in lieu of share certificate number and prominently print it as a duplicate share certificate for identification. Next one. Time limit. Unlisted companies, duplicate to be issued within 3 months. So if you have applied for a share certificate of unlisted company, that certificate must be given within 3 months. If it is a listed company, duplicate to be issued within 45 days. 45 days of filing application. Record keeping, so maintain a record, maintain a register at registered office. No physical share certificate required. Depository records are prima facie evidence of the ownership. And manner of issuing certificates or duplicate certificates, you can see here prerequisites. First of all, prerequisites: surrender the letter of allotment or fractional coupons. Share certificate must be in form SH1. On share certificate, names of the shareholders, number of shares held by the shareholder, amount paid up. So paid up value, you have to print it on this share certificate and record the details in the register of members. So maintenance of share certificate records, blank forms, that means unprinted forms, which should be machine numbered and printed under board resolution. Form should be kept in the custody of company secretary, and records should be maintained for at least 30 years permanently in case of disputed ownership cases. Surrendered certificates shall be defaced and can be destroyed after 3 years subject to board resolution and in the presence of authorized person. So in case any fraud happens in printing the duplicate certificates, so with an intent to deceive the members, with an intent to deceive the company, then the punishment to the officer in default will be 447. And what is the punishment to the company? Fine minimum 5 times of the face value of the shares, maximum 10 times or 10 crores, whichever is higher. Say for example, 1 crore worth face value of shares have been duplicated fraudulently. Now minimum fine will be 5 into 1 crore, 5 crores, maximum 10 times of 1 crore or statutory limit of 10 crores, whichever is higher. So 10 times of 1 crore means 10 crores only. 10 or 10, whichever is higher, means 10 only. So minimum 5, maximum 10. This is the punishment to the company, not to the officer in default. Officer in default gets punishment under section 447. Next, section 47, voting rights of the shareholders. Every equity shareholder has a right to vote on all resolutions placed before the company. This is about which shareholder? Equity shareholder. Nidhi companies. This is the most highlighting point, exceptional point. A member cannot exercise voting rights exceeding 5% of the total voting rights. There should be no concentration of power in few hands. So maximum a member of Nidhi company can exercise 5% of the total voting power. Even though he hold 10% of the share capital, 20% of the share capital, he can exercise only 5% voting power of the company. So voting right applies to the resolutions. In case of preference shareholders, voting rights apply only to the preference, to the matters affecting their rights, winding up of the company, repayment or reduction of the equity or preference share capital. So in case of poll, voting rights are proportional to the shareholders' share in the paid up preference share capital. Simply, so total share capital 10 crores. You are holding 1 crore paid up share capital. So in what ratio? So what would be the ratio of voting power to you? 10% is the voting power to you. In what proportion? So you are holding to the total paid up share capital of the company. Next one, non-applicability. Section 47 does not apply to the private companies, specified IFSC public companies, provided AOA provides otherwise. Next one, next exceptional point. If preference dividends remain unpaid 2+ years, those shareholders will also exercise voting power on all resolutions along with equity shareholders. Once those dividends are paid, once these people dividends are paid, their voting rights will come to end. These people voting rights will come to end. Getting my point? Remember, they may confuse you in the examination. What would be your answer in case of non-cumulative preference shares? I'm telling you, whether it is cumulative or non-cumulative, not a matter. Whether cumulative or non-cumulative, preference dividends not paid for 2 years continuously. From next year onwards, preference shareholders will also get voting power along with equity shareholders. Now, based on this section, you can see exceptional question. Exceptional question. Apex Mutual Benefit Nidhi Limited, Nidhi Company, incorporated on 10th April 2022, is a public company registered as a Nidhi Company under Section 406 of Companies Act 2013. The company has 600 members as on 31st March 24. Paid up share capital 12 lakhs. During the AGM on 15th September 2024, a poll was demanded on ordinary resolution relating to appointment of the director. One shareholder, Mr. Karan, holds 80,000 paid up share capital. 80,000 share capital. So 80,000 divided by 12 lakhs. 80,000 divided by 12 lakhs. So it is 6.67 percentage. 6.67 percentage. Let's see. Resulting in 7% of the voting rights. That means round off 6.67, round it off 7% like that. But actually 6.67% only. Based on the total paid up equity share capital. The managing director proposes allowing him full voting rights based on his actual shareholding. Examine whether Apex Mutual Benefit Nidhi Limited is complying with the mandatory requirements related to the voting right restrictions. The answer is no. Not complied. Why? In a Nidhi company, irrespective of holding, maximum a member can exercise 5% voting power. Getting my point? If his holding is 4%, 4% voting power. 3%, 3% voting power. 10%, 5% voting power only. Remember this exceptional point. And another exceptional point you have to remember is preference shares holders not getting dividend for 2 years. Whether cumulative or non-cumulative, both get voting rights from the next year onwards. Once their dividends are paid off, then their voting rights will come to an end. So next question is about variation. Let's see next point, variation. Variation of the rights of the shareholders. Just remember 4 points. One is check the constitutional documents whether MOA AOA provides for variation or not. If not, look at the issue terms, maybe private placement or maybe prospectus. In the absence of such provision, that means if it is not prohibited by the terms of the issue, then variation is allowed. And how variation can happen, or how a variation will be effective? How variation comes into the force? At least 3/4 of the holders of issued shares of that class. 3/4 of the value of, 3/4 of the issued shares holders. Getting my point? 3/4 of the issued shares holders of that class or special resolution in a separate meeting. See, for this, for you, if postal ballot is applicable, then 3/4 value holders must give consent in writing. If postal ballot is not applicable, that means if your number of members are less than or equal to 200, then for you, separate class meeting you can conduct. In that you can pass special resolution. Getting my point? Postal ballot applicable, then 3/4 value you should get consent from the holders holding 3/4 value. Or if postal ballot is not applicable, conduct a class meeting, obtain a special resolution. Clear? If variation affects the rights of another class, consent of 3/4 of that other class is also required. So if holders of 10% or more, if holders of 10% or more of the issued shares of a class did not consent, they can apply to the NCLT to cancel the variation. So which provision should I repeat, ma? Which provision? First, look at the constitutional documents, that is MOA, AOA. If MOA, AOA allows for variation, you can proceed with variation. If MOA, AOA is silent, then look at the issue terms. That means prospectus or private placement document. In that document, variation should not be prohibited. If variation is prohibited, then variation is not allowed. So after looking these constitutional documents, get consent from the shareholders whose rights are getting affected. Sir, how much consent I should get it, sir? You know, if postal ballot is applicable, 3/4 of the class capital holders representing 3/4 of the class capital must give consent in writing. If postal ballot is not applicable, conduct a class meeting, that means separate meeting, get special resolution. If variation is affecting rights of another class, then consent of other class is also required. How much consent? 3/4 in value of the other class. Getting my point? If you want an example, see ma, ordinary shares, 1 share equal to 1 vote. Differential rights, 10 shares equal to 1 vote. Now we decided to increase voting power of the differential rights. For example, if you are increasing voting power of differential rights, ordinary shareholders voting power proportionately will be reduced. So rights, variation affecting one class having effect on another class, now you have to take similar consent from another class members also. Getting it? So if holders of 10% or more of issued shares of the class did not consent, simply dissenting shareholders can file a petition with NCLT. For this, they should have a status of 10% of the capital, 10% of the class capital, and they should file petition within 21 days of variation. Now NCLT will decide whether variation to be allowed or not to be allowed, and tribunal decision is binding. Company shall file a copy of tribunal order with ROC within 30 days. Special points you can see: issuing new preference shares pari passu with existing shares does not require consent of existing preference shareholders. That means equal priority. So doesn't require the consent of existing preference shareholders. Next one, cancellation of shares or reduction of capital does not amount to the variation of class rights. This we will see in section 61 and section 66. Is it okay? So on this, let's see exceptional question. Galaxy Motors Limited, a public company, has two classes of share capital. See, section 48 is applicable only when companies having two or more classes of share capital. Equity shares, preference shares. Equity shares, ordinary voting rights. Preference shares, 12% dividend. On 10th October 2025, the board proposed altering the rights of preference shareholders by reducing preference dividend from 12% to 8%. Articles of association contain a power to change rights of the class of shares. In a separate meeting of preference shareholders held on 5th November 2025, the holders of 4,20,000 preference shares voted in favor. See, 420 out of 6 lakhs, 4,20,000 out of 6 lakhs means 70% only. I got consent of how much? 70%. Is it okay? Can I proceed? So I think your doubt resolved, right? Fine. Sima, 4,20,000 preference shares out of 6 lakhs preference shares means 70% only. For me, how much consent is required? 3/4 consent is required. 3/4 consent is required. But how much consent I got? 3/4 means how much? 75%. How much consent I got? 70% only. So variation allowed or not allowed? While holders of 1,80,000 preference shares opposed the proposal. Okay. Company decided to implement the variation immediately. Examine whether variation in rights of the preference shareholders is valid under the section 48 subsection 1. No, not valid, because requisite majority not achieved. State the further remedy available to the dissenting preference shareholders and time limit to apply. See, for dissenters, they can go to NCLT within 21 days of variation, but for dissenting shareholders, this remedy is not required. Why? Because variation is not effective. Variation is not effective. For variation, 3/4 of the class capital consent is, holders of 3/4 of the class capital consent is required. But here we got only 70% consent, so variation is not effective. But dissenters, if they want, they can go to NCLT within 21 days of variation. Clear? Next topic, very simple topic 49, 50, 51. So I think no need of an exceptional question on this. So no need of exceptional question. Yeah, next exceptional question is sweat equity. Let's see, what is 49? Calls on shares. Remember, for calls on shares should be on uniform basis. That means all the members covered in one class, all the members belonging to one class, you can fix uniform call amount. That means, say for example, 2 rupees per share. 2 rupees per share is applicable to all the members belonging to that class. So few members 2 rupees, other members 3 rupees, like that, different call amounts can't be fixed out. Calls in advance. To accept calls in advance, To accept calls in advance, AOA authorization is compulsory, authorized by AOA. Getting my point? And advance payments, they are just liability to the company. They are not, that amount is not a capital of the company. Therefore, no extra voting rights. Remember, for calls in advance, there will be no extra voting rights. And section 51, subject to AOA, dividends may be paid proportionately based on the paid up share capital. That means, say for example, face value 10 rupee, paid up value 6 rupee. Now dividend of 10% was declared. How much dividend was declared? 10% dividend was declared. Now this 10% should be applied on 6 rupees or 10 rupees. That means on paid up value or face value? On paid up value or face value? The answer is, look at the AOA. If AOA provides pay dividend on paid up value, then 10% to be applied on 6 rupees. If AOA is silent, pay 10% on, apply 10% on face value, that is 10 rupees. Getting it? 10% on face value if AOA is silent. If AOA provides dividend on paid up value, then apply 10% on 6 rupees. The board may decide to pay dividends on pro rata basis, pro rata dividends, proportionate basis. Preference shareholders will get fixed rate of dividends. Next one, issue of shares at premium. For issuing shares at premium, AOA approvals not at all required. Companies Act is not placing any rules on fixation of securities premium. It's up to you, my dear directors of the companies. It's up to you. You can fix securities premium whatever amount you want. But I'm imposing conditions on utilization of securities premium. For all companies, utilization of securities premium, 5 purposes allowed. Utilization of securities premium, 5 purposes are allowed. BEP, break even point. B square, EP square. So B square means bonus, buyback. E means expenses connected with issue. Expenses connected with issue. P square means preliminary expenses written off. Next one, premium on redemption of securities. Premium on redemption of preference shares, debentures. So you can see here, fully paid up bonus shares, right of preliminary expenses, right of expenses connected with issue, that is commission, discount. Next one, buyback of shares or securities. Next one, but if you are a company following accounting standards in preparation of financial statements, for you, if AS is applicable, you can utilize securities premium only for B square E. P square not allowed. B square means, buyback, bonus issue. Buyback, bonus issue. And E means writing of expenses connected with issue. That means commission, discount. Getting my point? Next one, section 53. Issue of shares at discount is void. Issue of equity shares at discount. Issue of shares at discount is void. But we had 2 exceptions. Exception number 1, sweat equity. Exception number 2, converting debts into equity. A company may issue shares at discount to the creditors when its debt is converted into shares under a statutory resolution plan or debt restructuring scheme. The scheme complies with RBI guidelines, directions and regulations. So what are the 2 exceptions, ma? One is sweat equity, second one is converting debt into the equity. So this, I think you might have solved a lot of problems in internal reconstruction. So this you can observe in internal reconstruction related problems. So non-compliance, the penalty. What would be the penalty? Amount equal to the amount raised through discounted shares, or rupees 5 lakhs, whichever is less, not whichever is high, whichever is less. 5 lakhs or amount you raised through issue of shares at discount, whichever is less. Apart from the penalty, you need to refund all the money along with interest at the rate of 12% per annum. 12% per annum. And this restriction, issue at discount is applicable only to the shares but not to the debt instruments. If you remember, zero coupon bonds. In financial management subject, you might have solved many problems with respect to zero coupon bonds. So in zero coupon bonds, interest rate will be 0. But these bonds I will issue at discount. On maturity date, you will get amount which is equal to the face value. That means redeemable at par. Issued at discount, redeemable at par. Meanwhile, any interest payments will be there? No. That's why we call them as zero coupon bonds. Yes, debt related instruments you can issue at discount, but shares issue at discount is void. Next, section 54, expected topic in your examination. Section 54, that is issue of sweat equity shares. See, sweat equity shares, who are eligible to this sweat equity shares? Directors, employees, particularly permanent employees, directors, or whether working in India or outside India. Whether working in our company, holding company, subsidiary company. Three companies, ma company, holding, subsidiary. Either working in India or outside India. But employee should be permanent employee, director, executive director. Mostly you will see executive directors get sweat equity shares. So for providing some know-how or value addition or intellectual property rights. Value addition means, economic benefits. Either actual economic benefits or anticipated, future economic benefits. Simply financial benefits only. Economic benefits means financial benefits. Derived or to be derived from the know-how, intellectual property rights or professional expertise provided by the recipient. That means provided by the recipient of the sweat equity shares. So here, conditions, just remember conditions. First one is special resolution, and the special resolution is valid up to a period of 12 months. Within 12 months, allotment of sweat equity share should be done. Next one, for that, in explanatory statement, you specify these details, and also resolution should be passed covering these 4 factors: number of shares, current market price, consideration we getting, class of directors, employees eligible. If you are a listed company, comply with SEBI regulations, and sweat equity shareholders ranking is equal to the ranking of other equity shareholders. They get equal opportunities along with other equity shareholders. So important conditions for issue of sweat equity shares. Per year, the limit is 15%. In a year, at a time, you can issue 15% of your existing paid up share capital as sweat equity shares, or rupees 5 crores, whichever is higher. So let me put it in numbers. My existing paid up equity share capital is 100 crores. Now, for the financial year 25-26, I can issue sweat equity shares of 15%. That means 15 crores or 5 crores, whichever is higher. So definitely 15 crores. 25% lifetime limit. Sweat equity shares issuance must not exceed 25% of the paid up equity share capital. Suppose in 1 year I issued 15 crores. Next year 26-27, I can go with how much? In a year 15%, but during the lifetime of the company it should not exceed 25%. Already 15 crores I issued in previous year. Now I can issue balance, that is 10 crores only. Balance I can issue 10 crores only. So this percentage 15 or 25 to be applied on normal paid up equity share capital, not included. No, sweat equity share capital is not included. Sweat equity share capital is not included. So 100 crores is my normal equity share capital. So on this, 25% means 25 crores. This is my lifetime limit. To increase this 25 crores, I need to increase paid up equity share capital. Next one, in a year the limit is 15%. So in a year I can go up to 15 crores, but throughout the lifetime of the company I can go with 25 crores sweat equity share capital. But for startup companies, relaxation is there. Up to 10 years of incorporation, they can go up to 50%. Every year 15, 15, 15 like that. Total 50% for them. Only one limit is there. What is that one limit? 50% of existing paid up equity share capital, because startup companies face lot of liquidity crunch, so they won't generate revenue. They are in research phase. So to compensate employees adequately, they offer sweat equity shares. Lock-in period. So remember, lock-in period is 3 years. From the date of allotment, these shares are not transferable up to 3 years from the date of allotment. Valuation should be done by the registered valuer, because here the consideration I'm getting is non-cash consideration. In section 62, you will see issued shares for a consideration other than cash. Registered valuer valuation report is compulsory. And IPR's know-how value addition should be valued by the registered valuer with justification report. Disclosures in the board report, disclosures in the registers. If you are getting any asset because of issuing sweat equity shares, if you are getting some intangible assets, record it in the balance sheet and amortize over a period of its life. But if you are getting nothing, expenditure incurred during research phase, if you remember PGBP, expenditure incurred during research phase shall be charged to P&L account. Expenditure incurred during development phase shall be capitalized. Sir, research is going on. Nothing was, there is no significant improvements at all. We don't know whether it will be successful or not. It is just normal, we are doing research. In that case, don't record any asset, because asset you can record only if research is successful. So that's why in that case, you charge that sweat equity shares amount to the P&L account in the form of salaries and wages. Simply, if you are getting any asset, the entry would be IPR account debit to equity share capital. If you are not getting any asset, then salary and wages account debit to equity share capital account. So the salary and wages will be debited to profit and loss account. So based on this, let's see exceptional question. VR Digital Labs Private Limited incorporated on 1st August 2021, which is a startup recognized under DPIIT. It has a paid up equity share capital of 12 crores consisting of 12 lakhs equity shares of 10 each. During the meeting on 10 January 25, board proposed to issue sweat equity shares to Mr. Arjun, an employee developer responsible for creating a patented AI software that is generating major revenue. Key details: number of sweat equity shares offered 4 lakhs. Market price 50 per share. 12 crores 12 crores. Startup company means into 50%. Up to 6 crores sweat equity allowed. So just 4 lakhs only, right? Consideration: non-cash value of patented software. Registered value report obtained for both shares and IPR value. Board proposes lock-in period of 1 year only. Statute is telling 3 years. How can they fix 1 year? Wrong. Special resolution passed on 15th January 2025. Issue scheduled on 31st December 2025. So issue should be completed within 12 months of special resolution. So this is okay. So the director's report for the financial year 24-25 does not include details of the sweat equity shares to be issued. This is also wrong. Disclosures in board report is compulsory. As per the auditors, company has already issued sweat equity shares equal to 20% of paid up share capital in previous years. No problem. For startup, limit up to 50% is there. So startup benefit 50% limit is there. So total 2.4 crore already they issued, right? So 12 into 20% means 2.4 crore plus 4 crores. Sir, how you got it? Face value generally 10 rupees only. I think in question they have mentioned it. Face value 10 rupee. So 4 lakhs into 10, 40 lakhs. So total it would be 2.4 crore plus 4 crores, which is 6.4 crores. Acha, wait. 4 lakh equity shares, right? Is it 4 lakhs or 40 lakhs? Oh, printing error ma. Printing error. So 12 lakh equity shares of 10 each. The printing error is 1.2 crore. 12 lakh equity shares of 10 rupee each. Yeah. So drafting error. I'll update this document. Don't worry. I'll update this document and I'll change that document in the Google Drive. You can see in the description, link is there, right? I'll update it. So this is not 12 crores. This is 1.2 crore. This is 1.2 crore. 12 lakhs into 10 lakh, 10 rupees, 1.2 crore. So 4 lakhs into 10 means 40 lakhs. Already 20% was issued, right? So 1.2 crore into 20% means it would be 2.4 lakh. 2.4 lakh right now, sorry, 1.2 crore into 20% means it's not 2.4 lakh here. It's 24 lakhs. Small error, it will kill our senses, right? It kills our senses. In examination also, so small panic definitely disturbs your confidence. That's for sure. This is an evidence. I'm also facing it. Okay, fine. So let me correct it. So 1.2 crore is the amount. So 1.2 crore into 20% means 24 lakhs. And offered sweat equity shares is 4 lakhs into 10, that is 40 lakhs. So total it would be 64 lakhs. What is the existing capital? 1.2 crore. And sweat equity, proposed sweat equity 40 lakhs, existing sweat equity 24, so 64. So now 64 lakhs divided by 1.2 crore, that would be 53.33%. 64 divided by 120. 53.33%. So limit exceeded, not allowed. Limit exceeded, not allowed, which equals to 53.33% of paid up share capital. Lock-in period generally 3 years, but they proposed 1 year, which is not valid. Allotment timing within 12 months, this is valid. Board report disclosure, not compliant. So this is also an exceptional question only, where you are applying the provisions to the scenario. Getting it? All exceptional points you are applying. So, out of 4, 3 not allowed. More than 50%, 1 year. Next one, allotment is valid, but board report disclosures not valid. Next question is about redemption of preference shares. So section 55, issue and redemption of preference shares. For issue of preference shares, the conditions to be satisfied is special resolution in the general meeting. But before that, AOA authorization. AOA authorization. If I'm a student, while reading this kind of long content questions, what I do, after reading first time, second time and third time, fourth time, I will practice it in the margins. How? Let me show you. You can see here margin, right? In the margin, I'll write like this: AOA authorization, special resolution in general meeting. Next one, no subsisting default. No subsisting default with respect to existing preference shareholders. One is redemption, other one is payment. Next one, irredeemable not allowed. Irredeemable not allowed. Maximum tenure is 20 years. Maximum tenure is 20 years. But infra companies, company engaged in infra projects, for them 30 years. Provided 21st year onwards, every year 10% redemption should be done. 21st year onwards, every year minimum 10% redemption should be done. So by the end of the 30th year, you will find 10%. So after redemption, it becomes 0. Getting it? So entire text, you can see, I'm just reducing the content in the margins. Now whenever I want to revise this concept, I won't read complete content. I'll just go through the margins, and these points I'll highlight in the examination. I will highlight these points in the examination. Getting my point? So like this, the preparation should be done for theory subjects. Then only revision time will be saved. You can do lot of revisions. You'll get maximum marks by doing this kind of revisions. Morning also, I have seen a student, certified copies. The student is having good subject knowledge, but coming to the presentation, he is missing, small, minute points only he is missing, for which out of 5 marks, he got only 1.5 mark. His answer is correct, but minute points. In my opinion, they are minute points only. But valuer won't know whether it is weightage point or minute point, or valuer won't know. So he will check, whether your answer is at least, I'm not telling exactly it should match with suggested answers, but everything is covered or not. Every point is covered or not, he will check. So don't miss out the points. For that, revisions only helpful. Revisions only one option. For that, you have to do fast track notes like this. Next. Okay. Next one, redemption condition, sources. Yeah. Coming to the sources, redemption conditions. First one, profits eligible for dividends, distributable profits. Correct. Next one, proceeds from fresh issue made for the redemption. Only fully paid up shares will be redeemed. See, this is not a new point. Even in buyback also, you will see the same point. In buyback also, fully paid up shares can be bought back. Transfer to CRR. If you select free reserves for redemption of preference shares, then transfer nominal value of shares so redeemed to the CRR account. If redeemed from fresh issue, no CRR is required. CRR is required to maintain same capital base. That's it. Capital base should not be reduced, so that if capital base is reduced, it creates panic situation in the creditors. To eliminate that, just pass a book entry, free reserves account debit to CRR account. CRR will be utilized only for issuing fully paid up bonus shares. Sources for premium on redemption. Here classification of companies. All companies following accounting standards for preparation of financial statements. Companies following accounting standards, for them premium on redemption, they can utilize only free reserves. Whereas other companies, they can utilize either free reserves or they can utilize securities premium. They can utilize either securities premium or free reserves. But if you are a company following accounting standards for preparation of financial statements, for you mandatorily free reserves only one option, not securities premium. In section 52 we have seen it. Getting it? Now priority first, for premium on redemption, first you utilize securities premium only, because securities premium is having a lot of restrictions. Utilization of security premium is having a restriction. So first you utilize it. Next you can utilize free reserves. That's what, for certain companies, premium on redemption is provided before redemption from company profits. Getting it? But if you are following accounting standards, for you, free reserves is the only one option. Unable to redeem preference shares. If a company is unable to redeem preference shares or pay dividends, it may, with the consent of 3/4 in value of the preference shareholders and approval from NCLT, old shares will be redeemed. How the old shares will be redeemed? We will take back your old shares and we will give new shares. The new shares will cover not only the paid up capital but also the dividends that are outstanding over a period of time. So new shares will be issued for both our capital outstanding and dividends outstanding. So for these three conditions are important, ma. What are the three conditions? Get approval from the preference shareholders. How much approval? Holders holding 3/4 of the value of the capital. 3/4 of the capital. Suppose capital amount is 10 crores into 3/4 means 7.5 crore rupees paid up share capital. Holders must give consent. Then file a petition with NCLT. If NCLT gives approval, then you can redeem preference shares by issuing new preference shares which is equal to the due amount, that is including unpaid dividends. NCLT, while giving approval, may order for the redemption of preference shares held by a preference shareholders who have not consented to the issue of further redeemable preference shares. That means for them actual redemption. Dissenting shareholders only one option, actual redemption. Whereas approving shareholders for them deemed redemption. The issue or redemption of further redeemable preference shares does not amount to the increase or reduce the capital of the company. So three conditions. Just wait, ma. Yeah. Three conditions. Condition 1, 3/4 of the value holders consent. Condition 2, NCLT approval. Condition 3, dissenting shareholders actual redemption should be done. So based on this, let's see exceptional question. Blue Ocean Infra Limited, which is what is the nature of the company? Infra company, has following capital structure on 31st March 2025. Equity share capital 40 crores, redeemable preference share capital 10 crores, which was issued on 1st April 2008. The company proposes the following actions. On 10th April 2025, board plans to issue redeemable preference shares of 20 crores to finance a new port infrastructure project for 30 years. Allowed or not allowed? 30 years? Allowed. Infra projects, right? Up to 30 years allowed. The AOA do not contain any clause permitting issue of preference shares. Then you cannot issue preference shares. AOA express authorization is required. Earlier issued preference shares are due for redemption now. However, company is facing a cash shortage and has defaulted on dividend for the past 3 years. Having these defaults, new issue allowed or not allowed? Not allowed. Not allowed. CFO proposes redemption of these shares partly from profits 4 crores. So this amount you have to create CRR. Partly from fresh issue of equity shares of 6 crores. For this CRR, required or not required? Not required. He suggests no transfer to CRR as fresh funds are used. You utilize profits 4 crores, right? So CRR to be created. So CFO argument is incorrect. Company also plans to provide premium on redemption from securities premium account. A group of preference shareholders holding 30% of class objects to issuing further preference shares in lieu of the amount due. Okay. So objects, that means votes against. So votes in favor is 70%. Votes against how much? 30%. For deemed redemption of preference shares. For deemed redemption of preference shares, I need consent of 75% of the value. Did I get that much consent? No. So state whether company is permitted to issue new preference shares for 30 years. Actually, yes. But for that, AOA amendment is required and rectify the default. If you do these two things, allowed or else not allowed. Examine whether redemption plan and CRR treatment proposed by CFO is correct. No, not correct. Why? Because CRR requirement not satisfied. CRR of 4 crores must be transferred. And redemption partly from the profits and partly from the fresh issue. This is allowed. This is allowed. Redemption plan is allowed. But redemption out of profits, CRR to be created. State the remedy available when the company cannot redeem existing preference shares due to default, and whether dissenting 30% preference shareholders can block the proposal. Definitely they can block the proposal. Their blocking ability is valid. Why? Because we should get 3/4 consent, 3/4 value consent. Did we got 3/4 value consent? No, we got only 70% consent, which is less than 3/4. So they can block, they can object issue of further redeemable preference shares. Getting my point? Next, question 6 is related to transfer of shares. Question 6 is related to the transfer and transmission of securities. Just 1 second. Yeah. Transfer and transmission of securities. What can be transferred? If you are a company with share capital, securities can be transferred. If you are a company without share capital, interest of a member can be transferred. For that, proper instrument of transfer is required. It should be duly stamped, it should be duly dated and executed by both transferor and transferee, and not applicable for depository transactions. If shares are in demat form, for this transfer deed is not applicable. You tell me for Google Pay, Phone Pay, withdrawal receipt, transfer receipt to be filled or not to be filled? Not to be filled. Simply enter the recipient details, just enter OTP, that's it. Shall include names, address and occupation of the transferee. Shall be delivered to the company. That instrument of transfer shall be delivered to the company within 60 days of execution along with original share certificate. In case of no original share certificate, then at least letter of allotment. So how many days, document shall be submitted to the company? How many days? Within how many days document shall be submitted to the company? 60 days. And for government company securities, no instrument required for certain transfers in government companies. For example, bonds issued by the company, transferees should inform the company along with the bond certificate. Securities held by the government nominees, change of nominees, simply change of president. Change of president, not required. This instrument of transfer, all these things are not required. For them, other procedure is there, that specified or prescribed procedure you have to follow. Next. Exemption is applicable only to the government companies which has not defaulted in filing its financial statements, annual returns with the ROC. So non-defaulter. Next one, if instrument is either lost or not delivered within 60 days, company may register the transfer on the terms of indemnity bond as decided by the board. In case of partly paid up shares, where application for registration is made by transferor alone. Look at the conditions. Condition 1, partly paid up shares. Condition 2, application is made by transferor alone. Then don't register the transfer without giving notice to the transferee and wait for 2 weeks. Within 2 weeks of receiving the notice, if there is no objection from the transferee, then you can register the transfer. Getting my point? Condition 1, partly paid up shares. Condition 2, application made by transferor alone. If application is made by both transferor and transferee, or if application is made by transferee, then this provision is not applicable. Application is made by transferor alone and shares are related to partly paid up. Clear? Transmission. For transmission, instrument of transfer required or not required? Or not required. Normal intimation is enough. And here time limit of 60 days is not applicable. Transfer deed not applicable. Stamp duty not applicable. Getting it? So transmission arises in 3 cases: death of a member, insolvency of the member, lunacy. And time limit for delivering the certificates. Subscribers to the MOA, 2 months of incorporation. Allotment of shares, 2 months of allotment. Transfer or transmission of securities, 1 month. Allotment of debentures, 6 months of allotment. Securities by IFSC companies and private companies. IFSC public and private companies. IFSC public companies, IFSC private companies within 60 days of incorporation, allotment, transfer, transmission. For depository, immediately for depository. Observe the difference. Here I am talking about shares, here I am talking about debentures, here I am talking about securities. Securities include shares, debentures. So allotment of shares, different time limit. Allotment of debentures, different time limit. Allotment of debentures, 6 months. Allotment of shares, 2 months. Whereas transfer, transmission, whether it is a share or a debenture, within 1 month of receipt of transfer instrument or intimation of transmission, company should deliver certificate, security certificate. Getting it? So the deceased member's legal representative will have an option either to register shares in his name or directly sell them to the outsiders. So legal representative can transfer deceased person's securities or interest without being the holder of those securities as long as transfer is properly executed. So we assume legal representative is the original member, and accordingly if the transfer deed is executed properly, so shares will directly registered in the name of outsider. That's it. Default incompliance, penalty 50,000 rupees to the company officer in default. Depository in case of fraud 447. So based on this, one exceptional question we will see. So far, on this point, a question very rare coming question on this section is very rare. So that's why you can see one exceptional question. Nova Pharma, a public company. If it is IFSC company, 60 days is the limit, remember. Public company has issued fully paid up equity shares and debentures. Key transactions during the year. On 1st August 2024, transfer or executed a transfer of 2000 partly paid up equity shares in favor of Rohit. An instrument of transfer was submitted to the company by the transferor alone on 10th September 24. See, delivery happened within 60 days, ma. 1st August to 1st August plus 60 days means it would be mostly 29th or sorry 30th September mostly. So 10th September only submission was done. But what type of shares? Partly paid up, fully paid up, partly paid up. And who executed? Who sent this application to the company? Transferor alone. Now company should not register transfer without giving notice to the transferee, without waiting for 2 weeks. Company registered, 15th September. Oh my God, company registered the transfer without notifying the transferee. Mistake. 5th October 24, a share transfer form was misplaced by the company's share department. Board refused registration, stating non-availability of SH4. Misplaced by the company share department. How can company refuse to register transfer? Mistake on the part of the company. With a mistake on the part of company, how company can refuse registration? Silly. So, violation, punishment. 30th October 24, shareholder Ms. Kavya passed away. Oh my God. Her legal heir applied for transmission of 1500 equity shares without furnishing any transfer deed. For transmission, transfer deed applicable or not applicable? For transmission, transfer deed is not applicable. Stamp duty not applicable. Consideration not applicable. Instrument of transfer also not applicable. 15th November 2024, debentures were allotted to the another set of investors. Share certificates have not yet been delivered. Allotment happened on 15th November. To this add 6 months. December, Jan, Feb, March, April. By 15th April 2025, debenture certificate should be delivered. 6 months, right, for debentures. So comment on the legality of the transfer. First one, transfer of partly paid up shares invalid because no notice to the transferee. Transfer when SH4 is lost. Company cannot refuse and must accept with indemnity. With indemnity. Ask him to furnish an indemnity bond. But of course, I agree, there is a mistake on the part of company management. So asking indemnity bond also not required in this case. Transmission on death without SH4, without instrument of transfer allowed? Yes, valid. Debenture certificate issue 6 months. So not yet complied, therefore penalty of 50,000. Penalty of how much? 50,000 rupees. Applies to both company and every officer in default. Getting it? Next one, forged transfer. Whether forged transfer valid or void? Void. Occurs when a company registers transfer of shares based on instrument of transfer with forged signatures of transferor. So here you will find three parties, who are the three parties? Original member. Original member. From this fellow, fraud person obtained these shares and he transferred shares to innocent buyer. He transferred shares to innocent buyer. So this fellow, Mr. Oreo, original member. Mr. Funny, for example, Mr. Funny is a fraudulent person who obtained shares from Oreo under forged transfer, and he further transferred shares to Mr. Imam, who is very innocent. Now, you have to discuss the rights and liabilities of each and every person. That's it. The point will be over. Okay. So original shareholder, his name initially was deleted, right? So company must restore the original shareholder name in the register of members. So bring back the name of original shareholder. Bring back the name of original shareholder. Next one, what is the remedy available to the innocent buyer? Suppose already shares transferred to the innocent buyer, sir. Then innocent buyer name will be deleted from the register. Sir, it's a loss to the innocent buyer. No, sir. Company should compensate innocent buyer. And company should restore original shareholder details. For that, whatever loss company is suffering, company can get that loss indemnified from the fraudulent person, that is Mr. Funny. And of course, this kind of concepts will not come into the picture in case of demat form of securities, because transfer instrument is not required for demat form of securities. Then how fraudulent, forged transfers will happen? Forged transfers will not happen. So based on this, one exceptional question you see. On 10th July 2024, Mr. Rohan, a shareholder holding 1000 shares, discovers that his signature was forged and his shares were transferred to Mr. Karan without his knowledge. Oh my god. So Rohan discovers that his signature was forged and already transferred to Karan without his knowledge. Based on forged deed, on 20th July 24, company registered Karan as a member. Now, who is Karan? Fraudulent person. Who is Rohan? Original member. On 1st August 2024, Karan sold shares to Isha, a genuine investor, innocent buyer, for 4 lakhs. 20th August 24, company registered Isha as a member. 5th September, Rohan files a complaint and demands that his name must be restored. Now company stands. They deny liability and ask Rohan to resolve the matter with Isha. Oh my god. See, here the main culprit is company. Why? They didn't verify the signatures, allowed forged transfer document and registered shares in the name of, Mr. Karan. So company is the defaulter. In this entire story, company is the defaulter. Getting it? Okay. So state the validity of the first transfer made to the Karan. Is it valid or invalid? Fraud, forged transfer is nullity. State the rights available to Isha, a genuine third party purchaser, whether she can be denied membership. Yes. Yes. Isha's membership, Isha will be protected, but Isha will not be a owner. Isha will not be a owner. Protected. Rohan legal status can be continued as a member. Whether Rohan continues to be the legal shareholder? Yes. Then what about Isha? Company must compensate Isha and restore Rohan. Then company will be at loss. No, sir. Company can recover that loss from Karan, who is the main culprit. Getting it? So Isha rights are protected. Isha will be indemnified. Company must indemnify Isha and company must restore the name of Rohan in the register. Main culprit Karan is liable to the company. Next one. Yeah. Next one is, so question 8, this is based on section 57, 58. Chalo, we will see. 57, punishment for personation. Not practical, which section? Since not practical, right sir? Yes, not practical. Fine. So section 57, punishment for personation of the shareholder. If you are intentionally changing your identity in order to claim security or claim interest in a company, interest, the word interest is with respect to company without share capital. The word security is with respect to company with the share capital. Or obtaining a share warrant or coupon. So either obtains or attempt to obtain, receives or attempts to receive any wrongful gains. Whether you received it or not, whether you received or attempted to receive, no matter, for you the punishment minimum 1 year, maximum 3 years imprisonment, and minimum fine of 1 lakh, maximum fine of 5 lakhs. Clear? Next one. Yes, transfer or transferee both executed transfer deed. Along with transfer deed, so the attached share certificate, all these documents were submitted to the company. Now company had two options, either to send notice of refusal or company should send a share certificate in the name of transferee. Notice of refusal should be sent within 30 days of receipt of documents, or share certificate should be submitted within 1 month of receipt of the documents. Same time limits only, 1 month, but don't interchange like 1 month equal to 30 days. Don't write like that. So share certificate should be issued within 1 month, or notice of refusal should be given within 30 days. For example, I got sweat equity shares with a lock-in period of 3 years. Can I transfer them immediately? No. If I transfer them, company will send notice of refusal. Getting my point? So if it is a valid reason, no problem. If it is invalid reason, then the aggrieved party, Mr. Transferee, can go and cry in front of NCLT. Sir, this is what happened. So I already paid consideration to transfer. Now company is not allowing the registration of company is not doing registration of the transfer. So what to do? NCLT will decide. NCLT may dismiss the order, or NCLT may order the company to register the transfer or transmission within the 10 days. Either NCLT may dismiss the order or NCLT may order the transfer or transmission to be registered within 10 days. But here in this section, the most interesting and important point is time limit for filing a petition with NCLT. Time limit for filing a petition with NCLT. If you are a private company, petition shall be filed within 30 days of notice of refusal. No notice of refusal. If there is no notice of refusal, then within 60 days of delivery of transfer instrument or intimation. In case of public company, just add 30-30 ma. Just add 30-30. If you are a public company, so add 30-30 within 60 days of notice of refusal, or in case of no refusal notice, within 90 days of delivery of transfer deed or intimation. So for this, let me draw one small time diagram. Small time diagram. Yeah. So this would be better. See, this is date of transfer. Sir, since transfer and transmission are not practical nowadays, there is a less chance of testing in exam, right, sir? ICA thumbline, expect from unexpected areas. We don't know how they are going to test it. So even a small point also, we need to stress it out. That's why I narrated a story on section 56. Even a small point also, we need to study deeply. Clear? No, listen ma. See, date of transfer. Within 60 days, submit documents to the company. Company receiving these documents, company must give certificate. Company must give certificate within 1 month, or else give notice of refusal within 30 days. If notice of refusal has been received, then shares belonging to private company prefer an appeal within 30 days. Public company prefer an appeal within 60 days of notice of refusal. Sir, notice of refusal is missing, sir. I didn't got share certificate, I didn't got notice of refusal, sir. Then when you deliver documents to the company, from that point onwards, shares belonging to private company, within 60 days of submission of documents, go and file an appeal with HCLT. Public company, 90 days. Just look at the starting point, ma. Just look at the starting point. Notice of refusal would be the starting point, then 30-60. Delivery of the documents starting point, then 60-90. Then 60-90. So these are the time limits. So here, let me write here, delivery of documents to the company. Delivery of documents to the company for the registration of transfer or registration of transmission. So if you want, you can take a screenshot of it. If you want, you can take a screenshot of it. So next point. So next point is about rectification of, if NCLT order has not been followed. If NCLT order, if you are not complying with NCLT order, imprisonment up to 1 year, 1 to 3 years, and fine 1 lakh to 5 lakhs. Next one, rectification of register of members. I'm the member of company, but my name was omitted from the register. Or I'm not the member of the company, but my name is wrongly entered in the register. Either wrongly entered or wrongly omitted. Or suppose transfer has been registered, registration of transfer done, but company is committing some delay, or company is doing default in updating the register of members. So in these three cases, which three cases? Wrongly omitted my name, wrongly entered my name, and there is a delay on the part of company in updating the registers. In these three cases, the aggrieved party can go to NCLT. Now NCLT may dismiss the appeal, or direct registration of the transfer or transmission within 10 days, or direct rectification of register of members, records or depository, and the order of company to pay damages to the aggrieved party if applicable. So until then, transferee voting rights are available. But if NCLT is suspending the voting rights, then transferee cannot exercise voting rights. Transferee cannot exercise voting rights if voting rights are specifically suspended by the NCLT, and if depository is doing any kind of fraud, section 447 punishment is applicable. Okay, a small section, but based on this also one exceptional question, 58 and 59 combined, one exceptional question is there, 58 and 59, sorry, two different questions are there. Let's see. Harmony Foods Limited, a public company, received a transfer request on 5th January 2025 from Ms. Priya, who purchased 3,500 fully paid up equity shares from Mr. Nitin. A duly stamped SH4 and original share certificate was submitted on the same day. Board meeting was held on 10th January 2025. 5th January, 10th January. Okay. Company refused registration, stating these shares were sold to a competitor which is against the company business interest. See, public company shares are freely transferable. Private company restrictions can be placed. Public company freely transferable. This is not a valid reason. The notice of refusal was communicated to Ms. Priya on 20th January. That is within 30 days of delivery of the documents, valid only. However, AOA do not contain any restriction on transfer to the competitors. Meanwhile, company has declared a dividend on 25th January 2025 and the record date is 28th January 2025. So Priya claims that refusal is wrongful and demands recognition as a shareholder to receive the declared dividend. Comment the validity of the refusal by the company. So definitely refusal by the company is not valid. Refusal by the company is not valid. Advise Priya on the remedy and time limit available to challenge refusal. Since this is a public company, within 60 days from the notice of refusal, go and file an appeal with NCLT, appeal to NCLT from 20th January onwards. So 20th January onwards, you are having a time of 60 days. So Priya can file an appeal with NCLT. State how NCLT may deal with the matter. NCLT orders company to register the transfer and orders company to pay the damages to the aggrieved party. Comment on Priya's eligibility to receive declared dividend after refusal. So only a registered holder receives it. Priya, since transfer not yet registered, she won't be a registered holder. She won't be a registered member. Therefore, Priya cannot claim dividends. Priya cannot claim dividends. Understood? Next, question 9 on 59th section. Arun Fintech Private Limited, a company limited by shares, was incorporated on 15th April 2023 with an authorized share capital. First paragraph is of no use, ignore. In examination also, the first paragraph mostly, 50% waste only. Mr. Ramesh Gupta, a promoter director, held 6 lakh shares. On 5th January 25, he executed a transfer deed for 1.5 lakh shares in favor of Kavya Mehta for a consideration of 45 lakhs. Duly stamped, delivered to the company on 10th January 2025. Despite repeated reminders, company neither registered the transfer nor communicated any refusal till 20th February 2025. Meanwhile, due to a clerical error by the CS, the name of Mr. Sunil Rao, a former employee who had exited in November 24, continued to appear in the register of members with 20,000 shares, though his shares already been transmitted to his legal heir and consideration settled. So that means wrongful inclusion, wrongful omission. Further, on 1st March 25, company froze voting rights on the transferred shares of Ms. Kavya, showing the reason of internal complaints review without any order from the tribunal. Voting rights of a member can be suspended under this section only with NCLT authority, NCLT approval. Without NCLT approval, how can you restrict voting rights of a member under this section? So not allowed. Aggrieved by non-registration, wrongful entries and suspension of voting rights, Ms. Kavya Mehta filed an application before NCLT on 15th March 2025 seeking rectification and damages. Whether Ms. Kavya Mehta is entitled to apply for rectification of register of members under section 59? Yes, Kavya is an aggrieved party as there was unnecessary delay in registering the transfer without sufficient cause, so she is entitled to apply for rectification. Whether company's failure to register transfer and omission to rectify Sunil Rao's name is valid? Company's failure not valid. Company's inaction is invalid. as continued entry of Sunil Rao and omission of Miss Kavya amounts to wrongful entry and default. Whether suspension of voting rights by company without tribunal order is legally sustainable? No. For suspension of voting rights, tribunal permission, tribunal order is required. What powers can tribunal exercise in the present case? Order the company to rectify the registers within 10 days. So direct the registration within 10 days, rectify the registers and award damages under section 59 subsection 2 for the losses suffered. So next one is section 62, further issue of shares. But before that, we will see, small concepts. So this is the point, in all official publications, if you print authorized share capital, along with authorized share capital, you are required to print subscribed share capital and paid up share capital. If you print authorized share capital on any of the official publications, along with authorized share capital, you need to print subscribed share capital and paid up share capital. That is section 60, not required. So we had section 61. We had section 61, that is alteration of share capital. Process is different, and procedure is different, Procedure for alteration of capital, remember 3 points. One is check AOA permits alteration or not. Next, obtain ordinary resolution. Next, filing with ROC. This is the procedure. Coming to the process, capital alteration arises in 5 ways. Either increase or decrease. Consolidate, subdivide. Conversion of fully paid up shares. Observe carefully. Conversion of what type of shares? Partly paid up or fully paid up? Fully paid up shares into stock. Reconvert stock into fully paid up shares. But important point is, if consolidation and division results into the changes in voting power, prior approval of tribunal is compulsory. Consolidation and division results in the changes of voting power, NCLT prior approval is required. And in case of subdivision, say for example, face value 10 rupee, paid up value 8 rupee. In case of split, suppose face value, I'm dividing it to 2 shares, 5. Now in same proportion, paid up value should also be reduced, 4. Getting it? Cancellation of share capital is not a reduction of share capital. 61 is not equal to 66. That is the meaning of this point. Procedure, AOA, OR, ROC. AOA authorization, ordinary resolution, ROC filing within 30 days. Within 30 days of OR, communicate the same with ROC along with that file altered MOA with ROC. Next one, further issue of shares. First, give priority to the existing members. Why? Because they are our members, they are our owners. First priority should be given to the existing members. Next, you can go with employees for which special resolution is required. But if you are a private limited company, who has not committed a default in filing financial statements and annual returns, and if you are a specified IFSC public company, for you OR is enough. Generally for ESOPs, SR is required. But a private company which is a non-defaulter under section 92 and 137 and a specified IFSC company, for them OR is enough. Listed companies follow SEBI guidelines, SEBI regulations. Other persons other than employees, other than members, maybe public at a large or maybe identified persons, in that case shares issued for non-cash consideration, valuation report is compulsory. Now for rights issue, you need to issue a document called letter of offer. Specify the number of shares being offered, specify the time period for acceptance, which should be minimum 7 days, maximum 30 days. As per Act, minimum 15 days. But going to the rules, minimum 7 days. So offer period should be 7 to 30 days. What is the significance of offer period? During this period only, one can subscribe additional share. State that offer, if it is not accepted within the specified time, it will be deemed declined, and confirm rights to renounce. So renunciation is available to you unless AOA prohibits renunciation. Note, existing shareholder, if they decline the offer, then board of directors may dispose of these shares in a manner which is not disadvantageous to the company. There should be no loss to the company. On disposal of unsubscribed shares by the existing members. While determining the ratio of the shares to be offered, allocation should be fair as possible under the circumstances. If you're a private company or specified IFSC public company, shorter period is also allowed with 90% of the members' consent in writing. So that 7 days, that time limit for acceptance can be reduced with the 90% of the members' approval. Length of the notice. That means, uh, today if I give notice, when can I start offer period? Today if I give notice, when can I start offer period? Or to start offer period, before how many days I should give notice? And the answer is at least 3 days before opening of the offer, notice should be dispatched either via registered post or speed post, electronic mode, courier or any other mode. Courier or any other mode. For private companies, shorter notice period is allowed if 90% of the members consent in writing or electronically. So both, private companies, IFSC companies can reduce the tenure with 90% of the members consent. So board approval for rights issue to the existing shareholders, only board resolution is needed. General meeting approval is not required. Remember, bonus issue, members approval is required. Rights issue, members approval not required. Bonus issue, capitalization of profits, OR is compulsory. OR is compulsory. Whereas for rights issue, members approval is not required. One second. Yeah. Next one. But section 62 is not applicable in the below cases. What it is telling, if you go with others, special resolution is required. Special resolution plus registered valuer report is required. But in the following cases, special resolution is not required. There are two such cases. Case 1, when you have issued convertible debentures, where at the time of issue of convertible debentures you already passed a special resolution. Now at the time of conversion, new special resolution not required. Once again, special resolution not required at the time of conversion. Only at the time of issue of convertible debentures only you have to pass special resolution. And second one is central government directed conversion. Previously you got loans from the government or you issued debentures to the government. Now you are not in a position to pay that amounts. So government finding it necessary in the public interest on reasonable terms set by the government, even if the original debentures or loan do not contain the conversion. So this is based on government order. Based on government order. Remedy against forced conversion. If you feel, sir, this is not acceptable, sir, if this is not acceptable, go to the tribunal within 60 days of receiving government order. Tribunal will hear both the parties and pass appropriate order. So before passing any such order by the government will consider these 4 factors: financial position, terms of the loans or debentures, interest rate, and other relevant factors. And the highlight of this topic, government order is enough to increase your authorized share capital to the extent of proposed conversion. To the extent of proposed conversion, your authorized share capital will be enhanced. Further, section 61 is also not applicable. Nidhi companies, there is no such criteria, because in Nidhi companies, a person can become depositor, but before that, he should become a member. Nidhi companies, SR, ESOPs, outsiders, SR plus valuation report, all these things, section 62 is not applicable to Nidhi company. For them, separate set of rules are applicable. That's it. So this is all about section 62, ma. So in section 62, if you remember, 3 points are covered: existing members, letter of offer, employees, special resolution. But for 2 companies, OR. Others, SR is required. If it is a non-cash consideration, along with SR, valuation report is also required. Now coming to the letter of offer, it should be dispatched 3 days before opening of the offer. Offer period should be minimum 7 days to maximum 30 days. And it should contain a matter of rights renunciation, whether rights renunciation benefit is there or not. And it should also contain a disclosures. Disclosures of what? Disclosures of what? If members are not taking the additional shares, then the shares will be disposed of by the directors in a manner not disadvantageous to the company. Of course, this period of 7 days can be reduced with the consent of 90% of the member in the prescribed companies, that is, private company, IFSC company. Next one. Based on this, let's see exceptional question. Arohan Technologies Private Limited was incorporated on 10th June 2019. 10th June 2019. The company has a paid up share capital of 8 crores divided into 80 lakh equity shares of 10 each. Fully paid up. Company has no default in financial statements or annual returns, sir. And what is the nature of company? You see, private company. Private company, non-defaulter under section 137, under section 92 can issue ESOPs with just ordinary resolution. SR is not required. To fund expansion and retain key managerial talent, directors in its meeting held on 5th August 2025 approved issue of 12 lakh equity shares to the existing equity shareholders on a rights basis. Okay. And grant of employees stock option scheme covering 3 lakh equity shares to the senior employees. The letter of offer for rights issue was dispatched on 8th August, allowing shareholders 7 days to accept the offer. Written consent for shorter notice was received from 92% of the members through electronic mode. So for shorter notice, 92% consent from the members is already taken. So shorter notice will be valid. Actually 90% is enough, but they got 92%. 90% is enough, they got 92%, so valid. The letter also stated that in case of non-acceptance, board would dispose of the shares in such manner as it deemed fit. Further, ESOP scheme was approved by passing an OR in the general meeting held on 25th August 2025. One minority shareholder objected, contending that ESOP requires special resolution. No, private company can enjoy the privilege. Private company, which is a non-defaulter under section 137 and 92, OR is enough. The board has no power to dispose of declined right shares. Who told? Board can dispose them in a manner not disadvantageous to the company. So whether shorter time period of 7 days given for acceptance of rights issue is valid? Yes. As per rules, 7 days is allowed. Whether board is empowered to dispose of shares declined by the existing shareholders? Yes. In a manner not disadvantageous to the shareholders and company. Whether approval of ESOP by ordinary resolution is valid? Yes. Because company is a non-defaulter and it is a private limited company. If it is a public limited company, yes sir, pakka yes sir. If it is IFSC company, OR is enough. Whether objection raised by minority shareholder is legally sustainable? No. Objection is not sustainable since both the shorter notice period and ordinary resolution for ESOP are legally permitted. Let's see how many questions are still pending. Oh, 6 more questions. 6 more questions. Hardly for questions, 10 to 12 minutes enough. And for remaining topics, half an hour is enough. Mostly within next half an hour, we are going to close this chapter. Bonus shares, bonus shares. Sources available for bonus issue. Free reserves, security premium, CRR. Revaluation reserves allowed or not allowed? Not allowed. And what are the conditions for issue of bonus shares? AOA authorization. Next one, approval of the directors and approval of the members. Approval of the members is required for capitalization of profits. Capitalization of profits. Company must not have defaulted on interest or principal payments on fixed deposits. Statutory dues relating to the employees, that is PF, gratuity, bonus, and bonus shares and partly paid up shares must be fully paid up before issuing bonus shares. Bonus shares cannot be issued in lieu of dividends. It is not a distribution of the profits, it is a capitalization of undistributed profits. See, based on these 2 points, you'll find a crazy exceptional question. We'll see. According to the section 123 subsection 5, a company may capitalize its profits or reserves to issue fully paid up bonus shares or pay unpaid amounts on shares held by the members. So conditions you can see: AOA, board resolution, members resolution, no subsisting defaults, fully paid up shares can be issued as a bonus shares, and before issue, shares should be fully paid up. Your shares should be fully paid up, then only I can issue free shares, fully paid up bonus shares. Let's see the question, 11th question. PEL, a public company, limited by shares. I'm sorry, this is with respect to 62 only, ma. This is with respect to 62 only. Yeah, 62, one topic is pending, that convertibility is pending. Let's see first 11th question and then 12th question. But just now 12th question we completed, 12th question related concept we completed. So we'll see 12th question first, next 11th question, okay. Navodaya Textiles Limited, a public limited company incorporated on 1st April 2015, has authorized share capital of 30 crores and a paid up share capital of 18 crores divided into 1.8 crore equity shares of 10 each, fully paid up. As on 31st March 25, company had free reserves of 12 crores and securities premium of 3 crores. So available for bonus issue 12 plus 3, 15 crores. In a board meeting held on 10th May 2025, directors recommended issue of bonus shares in the ratio of 1:3, 1 equity share for 3 equity shares. What is the issued share capital? Issued, paid up share capital is issued share capital is 1.8 crore. So 1.8 crore into 1 divided by 3, that would be 60 lakhs. 60 lakhs into 10 means 6 crores. My source permits up to 15 crores, but I need only 6 crores. Okay. To capitalize a portion of its free reserves, the proposal was approved by the shareholders in the AGM on 20th June 2025. However, at the time of announcement, company had outstanding employee provident fund dues of 40 lakhs unpaid for last 3 months. Keeping this default, issue of bonus shares is prohibited. First, rectify this default. 5 lakh equity shares were partly paid up. First, you convert them into fully paid up. Without converting them into fully paid up, bonus issue not allowed. And certain shareholders argued that bonus shares amounted to distribution of dividends, which should be paid in cash instead. See, bonus issue is different, dividend is different. Dividends can't be paid in kind. Dividends must be paid in cash only. Bonus issue can't be made in lieu of dividends. Let's see. Statutory auditor cautioned that once board announces a bonus issue, it cannot be withdrawn. The management contended that bonus shares merely represent capitalization of profits and do not involve outflow of the funds. Whether bonus shares proposed by NTL amounts to distribution of dividends? Tell me, crazy question. Tell me, whether bonus shares proposed amounts to distribution of dividends? No, bonus issue cannot be made in lieu of dividends. You can see the answer. Bonus shares do not amount to the dividends. They represent capitalization of which profits? Undistributed profits as recognized by judicial interpretation in section 63. Bonus shares is not distribution of dividends. It is capitalization of undistributed profits. Whether issue of bonus shares is valid in lieu of outstanding statutory dues and partly paid up shares? Again, no. These are the defaults. No, not allowed. What are the permissible sources for issue of bonus shares? Permissible sources is free reserves, securities premium, CRR, but not revaluation reserve. Whether company can withdraw bonus issue after board recommendation? No. Once recommended, it cannot be withdrawn. Once recommended, it cannot be withdrawn. That's it. Now come back to 11th question. This is with respect to section 62. Small question only. We'll see. In bonus issue, if you ask me, that first one is a crazy question only. Second one also exceptional question. 3-4 normal points. 3-4 normal points. But first two are exceptional points. Next. PEL, a public company limited by shares, was incorporated on 1st April 2016. As on 31st March 2025, its authorized share capital was 20 crores and paid up share capital was 12 crores, divided into 1.2 crore equity shares of 10 each. To finance a large infrastructure project, PEL issued 10,000 secured compulsory convertible debentures of 10,000 rupees each, aggregating to 10 crores on 1st July 2022 to a financial institution. The terms of issue provided that debentures would be converted into equity shares after 3 years, subject to approval of shareholders by the special resolution prior to the issue. Accordingly, a special resolution approving the conversion terms was passed in the general meeting. Special resolution is required only for issue of CDs, not for conversion. So terms of issue provided that debentures would be converted into equity after 3 years, subject to the approval prior to the issue. So special resolution has been passed. Special resolution has been passed before issue of debentures only valid. Separately, PEL also availed a loan of 8 crores from CG in 2020 for revival of the company. In 25 April, government, considering public interest, passed an order directing conversion of 5 crores of loan into equity shares, even though original loan agreement did not provide for conversion option. The board expressed concern that conversion terms fixed by the government are unfavorable. Now let's see whether government is empowered to direct conversion of its loan into equity shares. Yes, government is having that power. What remedy is available to the company if it does not agree with the conversion terms? Go to NCLT within 60 days. Calculate the increase, if any, required in authorized share capital, assuming conversion price is 10 per equity share. So 5 crores, right? 5 crores divided by 10, 50 lakh shares. whether 50 lakhs authorized share capital permitted or not permitted, or even if not permitted, the authorized share capital shall stand increased automatically under government orders. Under the central government order, authorized share capital gets increased automatically. So 12 exceptional questions I completed. We are left with 4 only, and topics also small. I mean, two major topics, two minor topics. Buyback, debentures are there. Two minor topics you can see, reduction of the capital and restrictions on purchase of the shares. We will see, we will see. We'll finish in next 20-25 minutes. See section 64. Whenever there is alteration in share capital, whenever there is an alteration of share capital, whenever there is an order by the government to increase the authorized share capital for converting the government loans into equity share capital, or debentures issued to the government into the equity share capital, or whenever company redeems preference shares, in these three cases, communication with ROC is compulsory. Form number SH7, time limit is 30 days. Along with that, altered MOA shall also be filed. Non-compliance, default, the punishment, company 500 per day up to 5 lakhs. Officer in default 500 per day up to 1 lakh. This is the punishment. Okay. Next. Next. 66 to 71. Section 66 you can see here, but alternatively I'll show my handwritten notes. Alternatively I'll show my handwritten notes with respect to 66 to 71. So yes, I can save your little time. So this is my handwritten notes actually, which is available in website. Yeah, 66, right? Section 66, reduction of share capital. Reduction of share capital, you can see it happens in three ways. One is, one is cancellation of uncalled capital, cancellation of uncalled capital, cancellation of unrepresented capital, and payoff excess paid up capital. Payoff excess paid up capital. In three ways, reduction of share capital is permissible. One is cancellation of uncalled capital, cancellation of unrepresented capital, payoff excess paid up capital. So here this section is applicable to two companies: company limited by shares, company limited by guarantee with share capital. So application to be filed with NCLT. I'll give you each example. I'll give you one example to each. See face value 10 rupee paid up value 8 rupee. Now I want to reduce this 10 to 8. 8 minus 8, 0. Extinguishment of members' liability. Cancellation of unrepresented capital, internal reconstruction is the best example. Pay off excess money. Suppose face value 10 rupee, paid up value also 10 rupee. I don't want 2 rupees. I'll return 2 rupees and I'll reduce face value to 8. 8, revised paid up value 8, members' liability would be 0. In three ways, reduction of capital is permissible. Okay. So this is applicable to two companies: company limited by shares, company limited by guarantee with the share capital. For that, file an application with NCLT. NCLT approval is compulsory. Along with application, attach copy of special resolution, copy of minutes, list of creditors, auditor certificate with complying, confirmation of accounting treatment as per accounting standards. Now NCLT forward notice to CG, ROC, SEBI if your company is listed, and the creditors also. So to which creditors? For this you are giving a list of creditors, right? To all these creditors, notice will be served and NCLT will wait for 3 months. In case of no objection within the 3 months from these parties, NCLT confirms whether creditor dues were discharged, determined, secured, finally consented or not. After confirming this, NCLT will pass an order to reduce the share capital. Now publish in newspaper as well as website also. Publication in two newspapers: vernacular newspaper, English newspaper. Also file a copy with ROC. Within 30 days of NCLT order, file a copy with ROC. Yes, along with that, approved minutes. Minutes approved. Next one. Also mention revised share capital structure. That is, what is the number of shares after reduction? what would be the revised face value, what would be the revised paid up value. So that is the maximum liability of the members. These companies must not commit the defaults both in deposits as well as interest. Then only that company is allowed to reduce its share capital. In case creditor names were not mentioned, if creditor details are not given, if creditor list is not complete, then the persons whose names are missing in that list, the creditors whose names are missing in the list, they can file a petition with NCLT. Now NCLT will impose section 447 punishment on the officers, and members will get back their original liability. Which members? The persons who are the members at the time of registration of NCLT order with ROC. The persons, you can see here, the members, the person who was member of the company at the time of registration of tribunal order shall be liable to contribute towards the debt or claim. How much amount? Their original liability. Their original liability will continue. So entire section in one page you can see. Entire section in one page you can see. The difference between handwritten notes and this one, handwritten notes is a summary. For revision, handwritten notes. But coming to the examination presentation, you can't present the matter in the charts. Descriptive answer, you have to write, you have to attempt like this. Getting my point? Presentation point of view, this is important. And number of revisions point of view, this is important. Next one, section 67 over. With respect to 67, any practical question there or not? Let's see. Yeah, sorry, 66. With respect to 66, there is a practical question. Let's see. Ujjwal Infrastructure Limited is a public company limited by the shares, incorporated on 1st July 2013. As on 31st March 25, company had an authorized share capital of 40 crores, paid up share capital of 24 crores, divided into 2.4 crore equity shares of 10 each, fully paid up. Due to continuous losses over the last 4 financial years, a substantial portion of UIL paid up share capital has become lost and unrepresented by available assets. Accordingly, directors in its meeting held on 12th April 25 proposed a reduction of share capital by cancelling 8 crores of paid up equity share capital which was lost and unrepresented by the assets. The proposal was approved by the special resolution passed at EGM held on 10th May 2025, and memorandum of association was altered to reflect the reduced share capital. Application has been filed with NCLT for seeking reduction of the capital on 18th May 2025. At the time of filing application, UIL has a fixed deposits of 5 crores and interest of 30 lakhs was overdue. Keeping these defaults, reduction of capital is not possible. Rectify these defaults. One unsecured supplier having a claim of 90 lakhs was not included in the list of creditors due to management's ignorance of the claim. Now management gets punishment under section 447. Statutory auditor confined that proposed accounting treatment complete with section 133 of Companies Act 2013. The tribunal issued notices to the registrar, regional director and creditors. Since this is an unlisted company, SEBI is not there. Unlisted company, SEBI is not there. Tribunal passed its order confirming reduction on 20th July. Whether proposed reduction of share capital by cancellation of lost capital is permissible under 66? Yes. Cancellation of paid up share capital which is lost or unrepresented is permitted under section 66. Reduction of share capital happens in 3 ways: cancellation of uncalled, cancellation of lost capital, cancellation of unwanted capital. 3 allowed. In this 3, second one is there. Whether tribunal could validly confirm the reduction when interest on fixed deposits one is in arrears? No, tribunal cannot confirm reduction since interest on deposits is in arrears, which is prohibited under section 66. What remedy is available to the creditor for 90 lakhs whose name was omitted from the list of creditors? Don't worry. If company has committed default in repaying your dues, you can seek contribution from the members under section 66 subsection 8. Clear? Next, 3 more questions, 3 more questions. For this, restrictions on purchase of its own shares. So if you are reading my material, section 67, there is a small printing error, The printing error is with respect to these 3 points. Kindly rectify these 3 points, The loan amount does not exceed 6 months of employee's salary wages. Employees 6 months salary wages. rectify this point. Just rectify this point. Loan amount does not exceed employee's 6 months salary. So just strike off this point. And loan is to enable purchase of fully paid up shares. That's it. This is the minute correction you have to do if you are reading my material. Small printing error is there. So loan amount should not exceed 6 months annual, 6 months salary or wages. Okay. So this also I'll show my handwritten notes simply to save the time. I'll show my handwritten notes. Section 67. Section 67. So company limited by shares, company limited by guarantee with share capital has no power to buy its own shares. Of course, buyback is an exemption, and for Nidhi company also this provision is not applicable. For reduction of for redemption of preference shares also this section is not applicable. This section is not applicable in 3 cases. Restrictions on purchase by company or giving of loans by it for purchase of its shares not applicable in 3 cases. One is section 55, redemption of preference shares. Let me show here. Redemption of preference shares. A second case is buyback of shares. Buyback of shares. And the third one is Nidhi company. Nidhi company. Okay. Next, no public company directly or indirectly provide loans, guarantees or securities, even financial assistance to purchase or subscribe its shares of its securities or its holding company securities. Holding company securities also, financing someone to purchase shares of holding company also not allowed. And there will be no effect on section 55 redemption of preference shares. But we had 3 exceptions. Banking company in the ordinary course of business allowed. Company framed a scheme for which special resolution has been passed. Beneficiaries should be employees. Shares should be fully paid up. Listed company listed company from stock exchanges you can acquire these shares. Unlisted company, based on the valuation given by the registered valuer, you can subscribe or you can purchase those shares. But maximum finance under this scheme is 5% of the paid up share capital plus free reserves. Maximum 5% of the paid up share capital plus free reserves, maximum finance. On this point, last attempt 2.5 mark question came. 5 marks question came, but in that 2 questions were there, 2 sub questions are there. 1 point is on this limit. If you remember this limit, then you would have written that answer. You can see here, employee share purchase scheme. Employee share purchase scheme. Purchase of shares must be through a recognized stock exchange for listed company. For unlisted company, valuation must be done by the registered valuer. Purchase or subscription cannot exceed 5% of company's paid up share capital in free reserves, and voting rights not allowed. Voting rights will be exercised by the trustee. Employee loan, one minute correction you have to do. Maximum employee 6 months salary only allowed. And he should not be director, he should not be KMP. Employee should not be director, employee should not be KMP. Max 6 months salary or wages allowed. And with this finance, fully paid up shares only, you must subscribe or you must purchase. So that is all about section 67. And 67 related also one question is there. You'll be shocked. This kind of question comes in the examination. Getting it? Beyond this, you can't expect section 67 question. Let's see. Sudarshan Engineering Limited is a public company limited by the shares incorporated on 1st April 2016. As on 31st March 25, SEL had a paid up share capital of 20 crores and free reserves of 10 crores. The shares of SEL are listed on a recognized stock exchanges. Okay. In order to promote employee ownership, Board of Directors of SEL in its meeting held on 10th May 2025 approved the following proposals. To grant a loan of 12 lakhs to Mr. Arjun, a senior engineer, neither a director nor KMP, whose monthly salary is 1.5 lakh. 1.5 lakh into 6 months means maximum 9 lakhs finance is allowed. But how much you are financing? 12 lakhs. Will not be covered under exemption, violation only. To provide 1.8 crore to a trust formed for employees under employee share purchase scheme approved by special resolution for purchase of shares through a stock exchange. 1.8 crore allowed or not allowed? Let's see. Paid up share capital 20, free reserves 10, 20 plus 10, 30 crores. 30 crores into 5% means 1.5 crore. So here 1.5 crore allowed, but you are giving 1.8 crore assistance. That means here also exemption not allowed. Here also exemption not allowed. To extend a corporate guarantee to a private investor, enabling him to borrow funds from a bank to acquire equity shares of SEL. Corporate guarantor to private investor also not allowed. Guarantee not allowed. 3 violations only, ma. See, no, loan is invalid since it exceeds 6 months salary of 9 lakhs. Yes, assistance is valid since 5% is 1.5 crore. However, 1.8 crore exceeds the permissible limit, hence partly invalid. Employee purchase, employee share purchase scheme is valid only, but 1.8 crore finance not allowed. It is exceeding 5%. Whether SEL can provide corporate guarantee to a private investor? No, providing a guarantee to a private investor for purchase of own shares is expressly prohibited. But in this, in this most highlighting point, this section is not applicable to two companies, private or IFSC companies. These 3 points with respect to private companies, you can see. So what this point is telling, if the private company, neither, any other body corporate is not a member, other body corporate is not a member of the private company. Borrowings from the banks of financial institutions are less than twice of the paid up share capital or 50 crores, whichever is less, and no default in repayment of existing borrowings. If these 3 conditions are satisfied in the private company, then 67 is not applicable. IFSC public company also 67 is not applicable. Nidhi company also 67 is not applicable. Remember these 3 company names. Private company satisfying 3 conditions. IFSC public company, Nidhi company. This section not applicable. Also remember 2 limits which are there in this entire section. 2 limits. What are the 2 limits? 5% finance is allowed. 6 months salary is allowed. 6 months salary advance is allowed. Clear? Everyone? Everyone? So next, 68, buyback of shares. And if you are someone reading my material, buyback of shares, one correction is there in the buyback. Only one correction is there in the buyback. So that is, with respect to time limits, one small printing error is there. Just rectify this printing error. 20 days. Issue letter of offer to the members of filing with ROC. Just take a screenshot of this and I'll tell you how correction to be done. Take a screenshot of this and I'll tell you where correction to be done. So first, let me show you handwritten notes. Sources of funds. For making buyback, sources of funds, free reserve, security premium, issue proceeds. But shares in the buyback, shares in the issue proceeds should not be same. Conditions for buyback, AOA authorization. With the board resolution, you can go and make buyback up to 10% of the paid up share capital plus free reserves plus securities premium. That is, amount required for buyback. And with special resolution, you can go up to 25% of share capital plus free reserves plus securities premium. But at a time, you can't make buyback of 25% of paid up equity share capital. This is with respect to number of shares. This is with respect to amount to be invested in buyback. One is amount to be invested in buyback, other one is number of shares to be bought back. Post buyback debt equity ratio to be 2:1. Number of shares that can be bought back is up to 25%. But amount required for making buyback up to 10% amount, up to 10% of this limit, BR is enough. Up to 25%, SR is required. Post buyback debt equity ratio should be 2:1. Only fully paid up shares can be bought back. Only fully paid up shares can be bought back. And listed companies comply with SEBI regulations. Buyback should be complete within 12 months of board resolution or special resolution. Next, if special resolution is required, notice of meeting, along with that give explanatory statement. In that you disclose the material facts, classes of shares which are involved in buyback, necessity for buyback, amount required for buyback, and time limit for completion of buyback. Buyback can be done out of these 3 options. One is existing members, proportionate basis, open market, employees, under ESOP or sweat equity shares. Next one, Company has to file a declaration of solvency in SH9 with ROC and SEBI in case of listed companies. Should be signed by 2 directors, including MD, and also attach an affidavit. So this should be done before buyback, and you should state that, in a declaration of solvency, you should disclose that there would be no insolvency. The company would not be insolvent for the next 12 months. The company would not be insolvent for the next 12 months. Like that, express disclosure is required in the declaration of solvency. Time limits for completion of buyback. Time limits for completion of buyback. Take this one as a screenshot. So when you are reading my material, just a small correction. It's a small one line is missing, ma. One line is missing. That line, the missing line is letter of offer. After filing with ROC, it should be issued to the members within 20 days of filing with ROC. Within 20 days of filing with ROC, issue letter of offer to the existing members. That correction you have to do, but if you read my handwritten notes, you'll get a clarity. So letter of offer should be given to the members within 20 days of filing with ROC. Offer period minimum 15 days, maximum 30 days. Once you file an application for buyback, your applications will be verified within 15 days of closure of offer. And in case your application, if it is rejected, within 21 days of closure of offer, you will receive a communication. Payment will be done within 7 days of verification. That means, once verification is done, within next 7 days, either payment should be done or communication of rejection should be done. That is the point meaning. That is the meaning of the point. So remember the time limits. Within 20 days, communicate with the members. Within 20 days of filing with ROC, communicate with the members. Offer period minimum 15 days, maximum 30 days. Verification of offers should be done within 15 days of offer closure date. Communication of rejection should be done within 21 days of closure of the offer period, and payment should be done within 7 days after completion of the verification. Once buyback is completed, within 7 days, cancel all those shares which are involved in the buyback. And cooling period, no fresh issue up to 6 months. Rights issue also not allowed, but bonus, conversion, sweat equity, ESOPs, these are allowed. This is nothing but cooling period. During cooling period, how many months? 6 months. During cooling period, rights issue, fresh issue not allowed, but bonus, conversions, sweat equity, ESOPs are allowed. Register of buyback, maintain a register of buyback, which should be, who should maintain this register? CS or authorized person will make entries. Shares so bought back, consideration paid, cancellation of the shares, extinguishment, and others. Company has to file a return of buyback with ROC, and if company is a listed company, also file it with SEBI within 30 days of completion of buyback, and also file a declaration of compliance. Non-compliance of any section, punishment for company minimum 1 lakh, maximum 3 lakhs. If you make buyback out of free reserves or out of securities premium, nominal value of shares so bought back shall be transferred to CRR. CRR shall be utilized only for one purpose, that is for issuing fully paid up bonus shares. Next, buyback is prohibited in the following cases. If you had a default of repayment of deposits, interest on deposits, redemption of debentures, redemption of preference share capital, repayment of term loan, payment of interest on term loan, default in payment of dividends. If you are having these defaults, rectify these defaults. First you rectify these defaults and wait for 3 years. Up to 3 years of rectification not allowed. After 3 financial years, allowed. And non-compliance of 92, 123, 127, 129 also prohibits you from making buyback. So rectify these defaults and then you can proceed with buyback. So based on these points, we will see exceptional question. So let me write here, issue letter of offer within 20 days of filing with ROC. Offer period not less than 15 days, not exceeding 30 days. Proportionate acceptance allowed. Verification should be completed within 15 days. Payment should be done within 7 days of verification. Return unaccepted shares, and communication of rejection. Should be done within 21 days of closure. Within 21 days of closure. Those who are using my material, please make these changes. Covered all the points, ma. Let's see exceptional questions. So 2 questions are there, exceptional questions. Section 15 is also connected with 67 only. Forgot to do this, forgot to complete this one. Let's complete this one. Sampurna Agro Private Limited was incorporated on 1st April 2019 as a private company limited by shares. Paid up share capital is 8 crores. Free reserves is 4 crores. Okay. Company has borrowings of 14 crores. So that means, this is a private company. Twice of paid up share capital means 16 crores. But borrowing is just 14. That means twice of paid up share capital. Borrowings less than twice of the paid up share capital. Okay. This is a private company. Okay. No other body corporate has invested in the share capital of SAPL. Condition 1 satisfied. Private company. Condition 2 satisfied. Next one. Further, SAPL has duly filed its financial statements under 137 and annual returns under section 92 for all previous years, has not defaulted in repayment of the borrowings. Fine. In its board meeting held on 10 June 2025, SAPL approved granting a loan of 1.2 crore to one of its members to enable him to purchase equity shares of SAPL from an existing shareholder. Allowed. This is allowed. Why? Private company satisfying 3 conditions, C1, C2, C3. For them, section 67 applicable or not applicable? Tell me. Section 67 is not applicable. Condition number 1, no body corporate should be member of this private company. Condition number 2, twice of its paid up share capital. Borrowing should be less than twice of its paid up share capital. Condition number 3, no default in repayment of those loans. So we will write an assumption of condition number 3. Separately, Sarvodaya Nidhi Limited, a Nidhi company incorporated under Companies Act 2013, purchased its own shares from Mr. Rakesh, a member, on 1st May 2025 upon his ceasing to be a depositor of the company. Certain members contended that such purchase amounted to reduction of share capital under section 66 and was invalid without tribunal approval. Now let's see whether action taken by company is valid. SAPL is valid. Yes, it is valid, ma, because it has no body corporate investments, borrowings are within the limits, there is no default, fulfilling the exemptions under section 67. So yes, loan is valid. Whether the purchase of shares by Nidhi company amounts to reduction of share capital under 66? Whether purchase of Nidhi company amounts to reduction of share capital under 66? No, 66 is not applicable to Nidhi company. No, purchase of shares by Nidhi company from a member ceasing to be a depositor does not amount to the reduction of capital under section 66. Last question. What conditions must be satisfied for availing exemption under 67? Conditions: filing complaints, borrowing limits, protection of shareholders' interest. So 67, for getting exemption, for getting exemption, filing complaints, borrowing limits up to the twice of paid up share, not up to the twice of paid up share capital. It's less than. Students are confused with these limits. Less than, remember the limit, that is less than twice of the paid up share capital or 50 crores, whichever is lower. Okay. Next, last exceptional question of this share capital. After that, we had only one concept, debentures. I'll do a quick revision of debentures, don't worry. Prakash Motors Limited is a listed public company limited by shares incorporated on 1st April 2015. As on 31st March 25, company financial position was as follows. Paid up share capital 50 crores, free reserves 30 crores, security premium account 10 crores, secured and unsecured borrowings 120 crores. So you need to check debt equity ratio. 120 debt means equity money should be 120 into 1 by 2. So equity base should be 60 crores. So 120 is to 60, then 2 is to 1 ratio can be satisfied. Okay. Paid up share capital 50, free reserves 30, securities premium 10. So sources available for buyback is 40 crores, ma. Sources available for buyback is 40 crores. Articles of Association of PML authorized buyback of the shares. In the board meeting held on 10th June 2025, board approved a proposal to buy back equity shares worth 8 crores from existing shareholders on a proportionate basis using free reserves and securities premium. Buyback did not exceed 10% of the aggregate of the paid up share capital and free reserves. See, aggregate of the paid up equity share capital, how much it would be? 50 plus 30 plus 10. It would be 90. 90 into 10% means 9 crores. But the proposal for buyback is 8 crores only. So 8 is less than 9 crores. So board resolution is enough. Members approval, special resolution not required. Accordingly, buyback was authorized only by a board resolution without passing a special resolution. Company filed letter of offer in Form SH8 with the registrar on 15 June 2025 and dispatched it to the shareholders on 25th June 25. The offer remained open for 15 days. Declaration of solvency signed by 2 directors including MD was filed with the registrar and SEBI. Buyback was completed on 20th September 25. Buyback should be completed within 12 months of board resolution. And bought back shares were extinguished within the prescribed time period of 7 days. So whether PML is eligible to undertake buyback of shares under section 68? Yes, ma. Yes. Whether sources of funds used for buyback is valid? Securities premium, free reserves, valid only. Revaluation reserve not allowed. Calculate maximum buyback limit applicable to PML. Maximum buyback limit is 25% of paid up share capital, 50, free reserves 30, securities premium 10. 25%, up to 25% allowed. Up to 25% allowed. Yes or no? But here in the question, with the board approval, how much buyback they can do is the question, ma. How much buyback they can do is the question. Here also small modification, securities premium they didn't consider, ma. Securities premium they didn't consider. So here just I'll add 10. In the next days, before I do next chapter marathon, I'll update this one and I'll update this in Google Drive also. Don't worry. So 10% of 50 plus 30 plus 10, that means 9 crores. Maximum buyback limit with board resolution is 9 crores. 9 crores. Whether approval by the board resolution alone is valid in this case? Yes, board resolution alone is valid because it doesn't exceed 10% of the paid up capital. Free reserves. Free reserves include securities premium. Free reserves include securities premium. Whether debt equity ratio after buyback complies with the section? After making buyback of 8 crores, still 2:1 ratio will be possible only because 120 debt means equity base should be 60. Equity base should be 60. 90 crores right now we are having. In this 8 crores, even if we lose 8 crores also, 72 crores money will be there. Sorry, 82 crores money will be there. So 2:1 ratio satisfied only. Next one, whether dispatch of letter of offer after 10 days is valid? Letter of offer should be dispatched within 20 days. Within 20 days of filing with ROC. So yes, dispatch will be valid only. Whether keeping the offer open for 15 days is compliant? Yes, minimum 15 days, maximum 30 days. Declaration of solvency valid? Declaration of solvency will be valid if it is signed by two directors. Out of two, one must be the managing director. So yes, declaration is valid as it is signed by the two directors. Next one, whether PML can issue freely equity shares on 1st January 2026? No, cooling period of 6 months you need to check. So no issue of fresh equity shares within 6 months of completion of buyback is prohibited. So here the important point with respect to buyback, section 70 is important point. 2 times this point was tested. Keeping these defaults, you cannot make buyback. After rectification also, buyback is not allowed up to 3 years. Up to 3 financial years, buyback is not allowed. Getting my point? Now we are left with only one section, debentures. Debentures. On that exceptional question, there is no exceptional question, direct question only. So debentures includes debentures, stock, bonds, instruments evidencing debt. And debentures excludes instruments that were notified in chapter 3D of RBI Act 1934. Manner of issue of debentures, you can see, you can issue debentures whether convertible or non-convertible. For convertible, special resolution is required. For non-convertible, up to the limits, board resolution is enough. Exceeding the limits means greater than 100% of paid up share capital plus free reserves plus securities premium, that is borrowing powers of the directors. Exceeding the limits, 1 SR is required. Debentures shall not carry voting rights. Secure debentures redemption period should be up to 10 years. But if you are someone engaged in infra objects, infra finance or permitted companies, up to 30 years tenure is allowed. Appointment of trustee is required in case debentures are offered to the public or members exceeding 500. And charge should be created in case of secured debentures. So charge should be registered in favor of trustee. Properties might be belonging to the company or holding company or subsidiary company or associate company. Simply properties may belong to cash. Mobile market values. Remember, market value of charged assets should cover not only debentures but also interest. And trust deed should be executed within 60 days of allotment. Debenture redemption reserve should be created with respect to only non-convertible portion, that too 10% only, for unlisted companies other than banks, financial institutions, all India financial institutions. I'll show DRR separately, ma. Investments deposits at the rate of 15% of debentures maturing the financial year. So this is applicable to both listed companies as well as unlisted companies. So DRR shall be created out of divisible profits, used only for redemption of debentures. Next one, appointment of trustee. Be careful with respect to beneficial owners. Disqualifications. So following people cannot become debenture trustee. Who are the following people? Beneficial holder of the shares, promoters, directors, KMP officer, employee of the cash company, relative of the above people, creditor, debtor of the group companies, surety of the debentures, and a person having pecuniary relationship during the current financial year, during the last two financial years, that for this fellow, having a pecuniary relationship also disqualified. For removal of trustee, 3/4 in value holders consent is required. For filling up the casual vacancy, board resolution is enough. If that vacancy arises due to resignation, board resolution plus majority of debenture holders approval is required. No. Let me show in the material. Trustee shall take all the steps to protect interest of debenture holders. Liability of debenture trustee fails to exercise care and diligence. Any provision exempting debenture trustee from breach of trust is void. It requires 75% of the debentures value holders consent for granting the exemption. So these are the conditions for exempting debenture trustee from defaults. Company has to pay interest and redeem debentures as per the terms and conditions, or else file an appeal with NCLT. NCLT will order for specific performance. And powers of the government can order for the procedure for securing debentures, form of trust deed, inspection, copies, DRR, quantum, and others. So these are the general conditions, ma. But let me show you with respect to DRR. Please take a screenshot of this. So DRR, 10% of the outstanding debentures, you have to create DRR. For all India financial institutions, DRR not applicable. Banking companies, DRR not applicable. NBFC, DRR not applicable. Housing finance companies, DRR not applicable. Only other than these four categories, you have to classify companies into listed, unlisted. For listed companies also, DRR is not applicable. DRR is only applicable for unlisted companies other than AIFI, banking company, NBFC, housing finance company. Clear? Only for privately placed debentures, DRR is applicable. So total 1, 2, 3, 4, 5, 6. 6 categories are there. Out of 6 categories, 1 category creation of DRR is required. That is the 6th category. Unlisted company issued debentures under private placement basis. And investment, applicability of investment, debenture redemption fund, 15%. DRR is 10%, but investment is 15%. It should be done by 30th April of the current financial year. With respect to all India financial institutions, it is not applicable. Investment not applicable. Banking company not applicable. NBFC, HFC. For public issue related, DRF, debenture redemption fund, is applicable. For private placement, not applicable. Next one, others, other than these 4 categories. Listed company, public issue applicable, private placement not applicable. Unlisted company, DRF is applicable, debenture redemption fund is applicable. So summary you can see here. DRR for unlisted companies, that is other than banking company, NBFC, housing finance company, all India financial institutions, DRR is applicable to this unlisted company. Whereas DRF is applicable to NBFC, HFC for public issue, listed company for public issue, unlisted company for private placement, because for unlisted company public issue is not allowed. Next, another point with respect to removal of trustee. Respect to removal of trustee, debenture trustee majority consent is required to fill up the casual vacancy caused due to the resignation. Whereas for removal, 3/4 in value debenture holders approval is required. Suppose debentures value is 100 crores into 3/4. So 75 crores rupees worth debentures holders must give consent for removal of trustee or exempting trustee from any punishment. Understood? So these 2 points, if you want, you can take screenshots also. Debenture trustee, filling up casual vacancy, and removal. So debenture voting powers, no. Debentures requisite consent for doing these things. So this, you take one screenshot. Just take one screenshot and then take this one also a screenshot. Take this one also one screenshot. Also take this one also one screenshot. Take this one also one screenshot. So with this exceptional topics in the share capital and debentures and entire share capital and debentures topic marathon is completed. So clear? So let me clarify you one more time. This is not a detailed revision also. This is like quick revision. Much explanation you will not find. In normal marathons, you will find at least one example. But since it's a quick revision, you won't find a more number of examples. First of all, no example at all. Just what is what, what is what, what is what. How that question can be tested in the examination. So like that, I prepared this things. I hope you understood these points, and in the given, in the video description, you will find a link, Google Drive link. You can download the document from the Google Drive and you can use it. But 2 mistakes are there. I'll rectify them. So tomorrow, before I start a new chapter revision, you'll find it. Okay. So tomorrow first hour would be FEMA. Tomorrow mostly 11:30 to 1, 1.5 hour I'll come for FEMA. I'll come live for FEMA chapter, and evening 8 to 9:30 once again I'll come live for LLP. So tomorrow the two topics which I'm going to cover is had a weightage of 28 to 30 marks. Okay. So tomorrow afternoon session FEMA 1.5 hour. Tomorrow evening session 1.5 hour LLP. So you can also see on the screen the weightage of FEMA and LLP. Clear? Fine ma. We will meet once again tomorrow. So good night.